Welcome to Breaking News to Trading Moves.
Glad to be here for this one.
Yeah, GameStop, the brick-and-mortar video game store that lives in your local strip mall right now, just offered $56 billion to buy eBay.
Which is just wild to even say out loud.
Yes, you heard that right. We're looking at a scenario that challenges the entire traditional hierarchy of corporate buyouts.
Right, because usually the established tech giant acquires the struggling physical retailer.
Exactly. Here we have a complete inversion of that usual dynamic. Our mission today is to look past the initial shock value of that headline and examine exactly how a physical gaming retailer attempting to buy a global online auction platform affects the broader market.
Because there is an actual underlying business logic here, even if the sheer scale of it feels totally disproportionate.
Right, and whether you are tracking volatile market action, monitoring the logistics sector, or simply curious about the future of online shopping, this single bid touches multiple areas of the economy.
We are so accustomed to seeing consolidation within the same tier of commerce, but this crosses lines completely.
It really does. Let's visualize the mechanics here for a second. This is basically like a local boutique trying to swallow a sprawling international shopping mall.
That's a really good way to put it.
Right, like the boutique has charm, it's got a dedicated local following and a very vocal customer base, but its physical footprint is tiny compared to the mall.
Yeah, and the mall has hundreds of stores, infinite foot traffic, and global reach.
Exactly. GameStop is that boutique operating physical storefronts. eBay is the international shopping mall, operating entirely in the digital realm, handling everything from vintage car parts to antique furniture.
And not only is the boutique trying to buy the mall, but they basically want to run the entire mall's shipping department out of their tiny back room.
Wait, really? Is that the actual plan?
That is the crux of Ryan Cohen's strategy here. He wants to transform GameStop into a broader commerce platform. The vision is to combine eBay's digital scale with GameStop's physical store footprint.
So the stores become, what, shipping centers?
Kind of, yeah. The physical retail locations stop being just places to sell newly released video games. They become operational hubs for the digital marketplace.
Wow.
They would handle authentication, intake, fulfillment, and live commerce.
Okay, I want to walk through the actual flow of that, because right now, if you sell a high-value collectible trading card on eBay, the process is entirely remote.
Right. You pack it up, ship it off.
Yeah, you ship it to an authentication center, wait for them to verify it, and then it goes to the buyer. It takes days, sometimes weeks.
And there's always that risk of damage in transit, which creates a lot of friction for the seller.
Totally. So how does this new model fix that?
Well, under this proposed model, the physical GameStop store becomes the authentication center.
Oh, I see.
Yeah. A seller walks into a local GameStop with a rare comic book, a luxury watch, or, a refurbished console. The staff at that location verifies the item on the spot.
Just right over the counter.
Exactly. They log it into the eBay digital system and either store it for local pickup or package it for immediate shipping.
That bridges the gap between physical and digital.
Right. Theoretically reducing shipping times and building trust in the secondary market. And trust is the most valuable currency in peer-to-peer selling.
Yeah. If a physical location can guarantee authenticity in real time, the platform gains a massive advantage.
Plus, Cohen's pitch also includes live commerce.
Like streaming.
Yeah. Picture an employee doing a live video stream right from the store floor, holding up an authenticated vintage video game and taking live bids directly through the eBay platform.
That turns a static retail space into an interactive auction house.
It completely weaponizes their foot traffic and their existing payroll. Instead of employees standing behind a register waiting for a release day, they're actively participating in global auctions.
Maximizing the utility of the retail space they are already leasing. Okay, that makes sense on paper. But the moment a $56 billion offer hits the tape, the market reacts instantly.
Oh, absolutely.
The most immediate reaction happens with the target company itself. eBay, trading under the ticker eBay, is the direct winner out of the gate.
Because the bid prices the company above its recent trading level, which creates a pricing floor for the stock.
Right, but what if the eBay board of directors ultimately rejects the offer? Which seems like a strong possibility given the unsolicited nature of the bid.
Even if they reject it, investors will start pricing in a higher offer from a different suitor. A rejected bid of this magnitude attracts activist pressure.
Because the activists smell blood in the water.
Exactly. Activist investors look at this premium and demand that eBay's board unlock that newly perceived value. They might push for enhanced shareholder return plans, asset spin-offs.
Or just demand the board find another buyer willing to match that $56 billion valuation.
Right. The narrative around eBay changes overnight from a mature, steady tech company to an undervalued asset in play.
And that spotlight then glares on the entire resale and auction sector. I mean, if a legacy marketplace like eBay commands a premium like this, traders naturally hunt for platforms operating in adjacent lanes.
Yeah, sympathy plays materialize rapidly in these scenarios.
Like who?
Platforms like Etsy, ticker ETSY, and the RealReal, ticker Real, capture increased attention.
The logic there is pretty straightforward.
Very. If physical retailers are hunting for digital marketplace acquisitions, specialized platforms possess the exact kind of digital infrastructure and active user bases that an ambitious buyer wants.
Right. Etsy dominates the handmade vintage niche, while the RealReal focuses on authenticated luxury consignment. A rising valuation metric for one marketplace lifts the perceived value of the others.
Exactly, but we also cannot ignore the specific energy GameStop brings to this conversation.
Oh, for sure. GameStop, trading under GME, remains one of the premier retail trading names.
A bold bid like this brings attention right back to high volatility names. It reawakens the retail trading momentum across the board.
And who benefits from that return of retail momentum?
The platforms facilitating those trades. Robinhood, ticker HHood, relies heavily on transaction volume.
Right. When retail investors flood into the market to trade the news of this acquisition, Robinhood captures the increased activity.
Yep, through payment for order flow and pure transaction volume. The rising tide of speculative trading directly feeds their revenue model.
And related stocks move almost out of habit. A company like AMC Entertainment, ticker AMC, moves in sympathy.
Not because AMC sells movie tickets online or runs auctions.
Right, but because traders rotate back into familiar setups. When GameStop dominates the news cycle, algorithmic trading programs and retail sentiment group those historical momentum names together.
The sentiment is totally contagious. That contagious sentiment drives capital into assets that share a similar investor profile, regardless of the underlying business fundamentals.
It's wild. The market trains the momentum of the retail trading base as much as the actual dollars involved in this specific buyout.
Algorithms literally scan for volume spikes in one meme stock and automatically allocate capital to historically correlated tickers.
Okay, so the trading screen is flashing green for these companies, but executing this strategy requires moving actual boxes in the real world.
Which is the hard part.
Right. Which brings us to the hidden infrastructure winners. And I have to push back on Cohen's master plan here.
Okay, let's hear it.
Can a standard retail storefront really handle the massive intake and shipping demands of an eBay-level operation? I mean, you walk into a typical strip mall GameStop, and there is barely enough room for 3 customers and a promotional cardboard cutout.
Yeah, it's tight in there.
Right. Where do they put thousands of packages? How do they handle the physical logistics of all that volume?
The short answer is they cannot do it alone. That is the exact friction point that defines the feasibility of this entire operation.
Because they just don't have the space.
Right. The storefronts cannot operate as standalone warehouses. They have severe physical space constraints. They have to act merely as intake nodes in a much larger transportation network.
So to make this physical to digital bridge work, there is a massive reliance on shipping, reverse logistics, and seller support.
They need the heavy lifters. They are completely at the mercy of the companies that already have the planes, the trucks, and the complex routing algorithms.
Companies like FedEx, ticker FDX.
Right, and United Parcel Service, ticker UPS, and GXO Logistics, ticker GXO, they become critical players here.
Any expanded marketplace strategy depends entirely on their infrastructure.
Especially when we discuss reverse logistics, which is, the process of handling returns or moving items from the buyer back to the seller, or an authentication hub.
Which is notoriously difficult to manage. Forward logistics is predictable, right? A centralized warehouse packs a uniform box and ships it to your house.
But reverse logistics is absolute chaos.
Let's break down why that is so chaotic. Like if I return a pair of shoes to a major corporate retailer, they know exactly what the item is, what box it belongs in, and which warehouse shelf it returns to.
Right, but in a peer-to-peer marketplace like eBay, every single item is unique. An authenticated comic book returning from a buyer in Ohio back to a seller in Texas, routing through a GameStop intake hub, requires individual condition checks, custom packaging, and specialized routing.
And on top of that, retail storefronts do not have loading docks. They have front doors.
Exactly. Having a huge delivery truck attempt to pick up 500 irregular packages from a strip mall location disrupts standard routing software.
So GameStop must rely on FedEx, UPS, and contract logistics firms like GXO to handle the complex web of non-standard shipments.
And those logistics providers stand to gain from a substantial increase in package volume. They're essentially the plumbing of this entire strategy.
Right. The delivery trucks get more business. But, making a $56 billion offer is one thing. Actually paying for it and running the operation carries severe risks for the buyer.
Very severe risks.
We need to look at the downside, specifically focusing on the hazards for GameStop and other speculative assets.
The financial architecture of this proposal is fraught with peril because the target, eBay, is much larger than the buyer, GameStop. Funding the acquisition requires a cash and stock structure.
Because GameStop definitely does not have $56 billion in cash sitting in a corporate checking account.
No, they do not. They have to use their own company stock as currency to make up the difference.
Which means, if you are holding GME right now, a cash and stock deal means your slice of the pie is about to get diluted. The company basically has to print millions of new shares to hand over to eBay's owners.
Right, your ownership percentage drops. And furthermore, acquiring a company of this size requires taking on a mountainous pile of corporate debt.
And the interest payments on that debt alone could severely strain the combined company's cash flow if the operational revenues do not meet expectations.
Which brings us right to the execution risk.
Right.
We're talking about a management team at GameStop that is used to dealing with physical inventory, retail leases, and console cycles.
And now they're proposing to run a global digital marketplace with complex bidding algorithms, international payment processing, and millions of independent sellers.
But the market is seriously questioning whether GameStop can successfully manage that transition. I mean, Ryan Cohen built Chewy, right?
Right.
But Chewy relied on the highly predictable bulk shipping of pet food. eBay deals in unpredictable peer-to-peer auction dynamics and fraud prevention.
The operational demands are vastly different.
Vastly different.
And the broader speculative appetite hinges on that execution risk. I mean, we have sentiment-heavy names like Coinbase, ticker Coin, and MicroStrategy, ticker MSTR, that often move alongside these retail-driven, high-risk events.
Even though neither Coinbase nor MicroStrategy sells video games or auction software.
Exactly. They operate in the cryptocurrency and digital asset space. But they share the same investor base.
Right. Traders who thrive on volatility and bold corporate moves. Risk appetite operates like a thermostat for these specific sectors.
So if the GameStop-eBay deal collapses under its own weight, or if the debt load terrifies the market, those sentiment-heavy names become vulnerable.
They can fall purely based on a broader retreat from risk.
Yeah, if the flagship speculative deal of the year turns sour, traders often face margin calls or choose to de-risk their portfolios across the board, dragging down Coinbase and MicroStrategy right along with it.
Tracking that execution risk is paramount. A failure here triggers a contraction in risk appetite that punishes speculative assets far outside the retail sector.
Okay, but what if it works? Now, if GameStop manages to overcome these risks, secure the funding, and successfully merge with eBay, the resulting entity creates an immediate threat to the established titans of e-commerce.
Oh, for sure. We go from talking about debt risks to a battle over specialized secondary markets.
The competitive landscape faces a sudden recalibration.
Because a revitalized combined marketplace becomes a powerful alternative for niched categories. Think about gaming, refurbished goods, motors, and collectibles.
Right, because the big competitors, Amazon, ticker AMZN, Walmart, ticker WMT, and Shopify, ticker SHOP, they dominate the broad retail market and everyday consumer goods.
But they don't necessarily dominate the specialized secondary market.
Right. If I want to buy a refurbished alternator for a 1998 sedan or a graded vintage comic book, I am probably not going to Amazon or Walmart. I'm going to a specialized marketplace.
And that is the exact wedge the new entity would use. By improving seller tools, altering pricing structures, and dominating those niche categories with physical intake centers, a combined GameStop-eBay applies sudden pressure on the giants.
So Amazon, Walmart, and Shopify might be forced to improve their own third-party seller conditions.
Exactly. Or lower their fees, or offer better support to prevent an exodus of independent merchants to the new, more aggressive platform.
Okay, so that covers the physical and digital storefronts.
Right.
Let's look at the actual transaction layer for a minute. How does the cash move from the buyer to the seller?
Right, the plumbing.
Yeah, any alteration to eBay's structure has to affect the companies handling the payments.
The financial plumbing is the fintech ecosystem. Any ownership change or strategy reset at eBay impacts embedded commerce tools, checkout flows, and seller finance.
And when you say embedded commerce, we mean integrating financial services directly into the shopping experience.
Right. So you go to checkout, and there is an option to split a purchase into 4 payments or take out a microloan.
That isn't the marketplace providing the loan.
No, that is a third-party fintech company integrated right into the platform's plumbing. PayPal, ticker PYPL, has historic links to eBay.
Yeah, they used to be the same company.
Exactly. And their checkout flows are deeply intertwined. If GameStop takes over, they might decide to push their own digital wallets, integrate cryptocurrency payments, or simply renegotiate payment processing fees to squeeze better margins.
And if they change the default payment methods, PayPal's transaction volume takes a direct hit.
The take rate, which is the percentage PayPal earns on every transaction, is highly vulnerable to a change in marketplace management.
And it's not just PayPal. Additionally, companies like Affirm, ticker AFRM, and Block, ticker SQ, are tied into the wider online payments and merchant services ecosystem.
Affirm handles those buy now, pay later options, and Block deals heavily with merchant services and point-of-sale systems.
So if the new marketplace ownership changes the rules of engagement for seller finance or consumer credit, the entire landscape for these fintech providers alters.
They all rely on the transaction volume generated by these massive digital marketplaces. A strategy change at the top cascades down into the payment processing layer.
Affecting revenue projections for companies that seemingly have absolutely nothing to do with video games or physical retail stores.
It all comes back to how interconnected these systems are.
It really does. We started with a staggering $56 billion headline, a brick-and-mortar gaming retailer trying to acquire a global online auction house.
And by looking closer, we see the practical impacts reaching far beyond that initial shock.
Yeah, we explored how this single proposal touches the shipping routes and reverse logistics networks of FedEx, UPS, and GXO. We examined how it reignites retail trading volumes for platforms like Robinhood and impacts the sentiment of names like Coinbase and MicroStrategy.
Not to mention how it forces e-commerce rivals like Amazon, Walmart, and Shopify to watch their third-party seller metrics.
Exactly. We even traced the effects all the way down to the digital checkout buttons managed by PayPal, Affirm, and Block.
It perfectly demonstrates how one aggressive corporate maneuver reverberates through the entire market ecosystem.
Every action forces a reaction across multiple sectors, testing the durability of supply chains and payment networks. Take a moment to evaluate your own portfolio or, your own online selling habits. How exposed are you to the logistics networks, the fintech payment processors, or the retail sectors that this single event touches?
Because the market is clearly not a collection of isolated companies, it is a complex web of dependencies.
Absolutely. What happens to a video game retailer in a strip mall can ultimately affect the routing algorithms of global shipping fleets. I want to leave you with a final thought to consider on your own. If an established, massive digital platform like eBay can become the target of a much smaller retail-backed company leveraging physical stores.
Which is still hard to wrap my head around.
Right. What other traditional e-commerce giants might suddenly find themselves vulnerable to unconventional, community-driven takeover bids? If the boutique can make a credible run at the shopping mall, the entire retail playbook is being rewritten right in front of us. Keep an eye on those seemingly impossible corporate matchups.